Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited for you to join me here today. We are going to kickstart the new year with helping you understand how to vet operators and, but more importantly, understand your investing goals. And the whole point of these boot camps is to really get very focused on skill building, right? So we, in our master classes, our weekly master classes that I hold every Tuesday, we're really about introducing you to topics, new ways of thinking about things, new avenues of investing in passive investments, maybe even introducing you to potential, new team members like lawyers, accountants and stuff like that, understanding what's happening in the news. But when we get to our boot camps, our monthly boot camps, we are focused on building skills. So today is an active boot camp. I want you here with me, not doing anything else. Turn off the phone, put everything on silent, and let's spend 45 minutes to an hour really workshopping your goals and how you can vet an operator in today's market. So first thing, I want you to go to your Q&A box and I want you to find that. So go down to the bottom of your Zoom screen, find Q&A, not the chat, Q&A that helps me stay organized as you have questions. And your first thing that I want you to go in there is tell me where you're joining from. It's always so interesting to see where all the different parts of the United States and even the world that our investors are joining from. So go to your Q&A box, drop in there, tell me where you're joining from. All right. And I will, awesome, Terry, Seattle, we got Dallas, Texas, fantastic. All right, you guys keep dropping those in. Whoop, I switched screens on you guys there. Okay, so really what this workshop is for is to help you answer a few questions. Maybe you've invested and you couldn't quite get comfortable with making a passive investment. You just didn't really understand what it is, like how it could benefit for you, or maybe you've actually invested in a deal before and you're like, oops, I made a mistake, or you're just so overwhelmed by all the information out there, you just don't even know where to start. Those are the big three questions that we help our investors solve here. Okay, so awesome. We got sunny Conifer, Colorado. I don't know about you. I'm in Boulder, Colorado today. The wind is ripping. I don't know about in Conifer. But guys, make sure you drop everything in the Q&A box. That's where I am going to be looking today. All right. So, but as we get started talking about our topic today, we need you to understand that we're going to be tackling a few different things. We're going to talk about those big myths that keep passive investors sidelined. Okay, we're going to talk about one of those today, which is lack of control. All right, how can you answer that question for yourself? How can I quote unquote control a deal? Okay, when you invest in a passive deal, you are giving up operational control, but there are so many other decisions you do control, and quite frankly, that are more important than that actually controlling the deal itself. These are things that you don't get to control if you're investing in stocks, bonds, and mutual funds, or if you're just have a CD at a bank. Okay, so passive investments can actually put you in a larger control of your investment portfolio, but we have to do it in a confident and secure way. All right. We also are going to learn how to properly vet investors. Okay, so I'm going to give you a high level vetting process. Take notes. All right. And I want you to be able to take those notes, and that way you can create your own vetting process. Okay. That is the point. Again, that's the skill that we're building today. All right. For those of you who don't know me, this is our first time meeting. My name is Whitney Elkins Hutton. Again, I'm the Director of Investor Education here at PassiveInvesting.com. If you want to talk all things passive real estate, you can join me at PassiveInvestingWithWhitney.com. I got some free goodies there for you. Also, you can take a look at our open deals there. But this is me and my crazy crew. This is the whole reason why I invest in real estate. Most importantly, passive real estate is so I can do what I want, when I want, with whom I want. And this is us spending the holiday season in Sedona, Arizona. And this is last year, so I need to update the photo. But this is, I started off real estate investing completely by accident in 2002. I bought a house with a significant other. Did very well on that house. After the relationship kind of crumbled, I fixed it up, sold it. I joke around that was probably my number one investing mistake. I should have held on to that property, but nonetheless, it kickstarted my real estate investing career. And over the years, I've scaled, just short of a 40-unit single-family rental portfolio. I have, flipped, about $1 million in property a year for a few years. Let's see, what else have I done? I've been the general partnership on 10 multifamily deals. I've also raised on over 29 multifamily deals myself. But the one thing that has helped me reach financial independence and financial freedom faster than any other investment I've made has been learning how to set my investing goals and invest in passive deals, getting really, really good at that, right? And fast forward today, this is, kind of what my husband and I's real estate portion of our portfolio looks like. We have over 6,500 multifamily units under me in partnership, 2,200 self-storage units, and 15 express car washes. We have a myriad of other investments, but that has helped us get 100% control and choice on how we spend our time. I just got off the call with a potential investor, and they were like, "Tell me how you reach financial freedom. Show me all the numbers." And I'm like, "Shoot!" They were like, "I want financial freedom now." And I was like, "What you want actually is probably the choice on how you spend your time, right? But financial freedom, having that money, having that cash flow coming in, is going to help you. It's going to be the tool to help you get there." And we can help you do that here at passiveinvesting.com. These are just a few of our vanity metrics. We've lent over $250 million in our rehab wallet loans. We have 1.4 billion assets under management and extremely strong returns to our passive investors. And again, before we launch into today's material, if you want to be connected to more educational material like this, our masterclasses, our boot camps, make sure you join me at passiveinvestingwithwhitney.com. Not only do you get that free education, you get to see our open deals. I've got some free goodies there that you can't get anywhere else on our website. And if you are serious about scaling your passive portfolio, you'll get access to my calendar. And let's talk all things about scaling that passive portfolio. All right. I have to put out a disclaimer, right? What we're talking about today is purely educational, not financial, legal, or tax advice. Anything that we go over today, I want you to take back to your consulting team, okay? Your legal team, your tax team, all right? If you have a financial mentor, okay? You don't have to necessarily have a financial advisor, but a mentor, somebody that has done this before that can help you, all right? All right. So as with anything that I do, okay, we've got all levels of investors here. We've got new investors that have no idea what passive investing means. And then we got investors that are like, they're the whiz. They know exactly what they're doing, and they're just looking for kind of that secret sauce, that way to optimize their portfolio. I'm going to start us at the beginning and kind of level set, okay? And that way we can build skills here. All right, the first thing is, what is a passive investment and why is it so powerful? Okay, the most important reason why I love passive investing, okay, over the single family rental portfolio I scaled, over fix and flipping, over being a general partnership on active deals, is that I was able to get massive leverage. I was able to get a return on my time that I could not get in my day job or any one of those active investment strategies, all right? Okay, now some of the strategies might have still been bringing in passive income, but they certainly were not passive with my time. And that is, again, one of the key freedoms that most passive investors are looking for. They are like, my time is so valuable. I need to double down on my day job because it provides so much income for me. So I can scale my passive portfolio. Or maybe you want to spend time with family and friends, with your kids, travel the world, whatever that is. For people who understand that their time is a non-renewable asset and they have a higher and best use for their time, passive investing can be a wonderful match. It helps you get that massive leverage. Okay. Now there's all different types of ways that you can invest passively in assets. Okay. You could do a syndication deal. You could do a REIT. There's so many, you can, invest in a stock ticker that invests in a REIT. Okay. But the way you can get the most control is to go on partnership on a deal. Okay. And you can really create great diversity with your portfolio in what we call private equity syndication deals. Okay. And really what private equity syndication means, those are some fancy words. It means you're just bringing a group of investors together to take down a large real estate property. Maybe it's an apartment building or a self-storage unit or express car wash. Maybe you guys are going to go provide preferred equity on somebody else's deal. Maybe you're going to lend money out to fix and flippers. Okay. That syndication is just a group of investors. You're harnessing the power of the group to go invest in another deal. Okay. In a large real estate deal. Okay. The reason why it helps you diversify your portfolio is that instead of you now figuring out how to take down a 5, 10, 15, even $40 million building, multifamily building, and having one investment in one market, okay, that one risk exposure, you now can invest a little bit across multiple projects, okay, and diversify your portfolio and have exposure to multiple operators, multiple markets, multiple deals, multiple asset classes. All right. So what does this relationship look like? We keep talking about partnership. Okay. That's what a syndication is. We're going to have the active team, the general partners, the operators, and then we're going to have the passive team, which is us as the passive investors or limited partners. And the relationship really works because when you look at a value triangle, I need to make a graph about this. You either have time, knowledge, or money to run a deal. Those are the three things that are required to run a deal. Most of us that are here on this call, we don't have the time. Yeah, we got to hire and better use with our time, like in our day job or being a mom, being a father, maybe it's being an entrepreneur, growing your business. Okay. We don't have the time to invest in real estate, but we understand the power. Okay. And maybe we don't even have the knowledge to invest in real estate. Maybe we do, maybe we don't. Okay. But we have the money and we want to put that money to use. Now, the general partner, okay, they have the deal, they have the knowledge, and they have the time. They have the business systems in place. They have the deal, the ability, desire to manage the deal, the time, the people, the systems, the lending, and credit. They need capital. The limited partner, which is us here on this webinar, we have capital to place. Okay, we don't have the deal flow or the ability and desire to manage the deal. Okay, or we don't have the time, the people, the systems, the lending, and credit, but we have that capital to place. Okay, so that's why this all fits together very neatly. Okay, we also, again, coming full circle, why syndications is that you can create massive leverage. Okay, if all of us here, as a passive investor, if you're in a passive investing deal, even just one, you are the CEO of your passive real estate portfolio. You are a business owner. Okay, and so we need to think like one. When we are hiring operators, we are hiring COOs, chief operating officers, for our passive real estate portfolio. And so we get to leverage everything that COO, that operator has. We get to leverage their knowledge of the strategy, market, their ability to underwrite secure lending. We get to leverage their expertise. We get to leverage their team. They've got the brokers, the property managers, the lenders, okay, all of the accounting team, legal team. We get to leverage their ability to secure the loan. We get to leverage the ability of them to attract other passive investors, okay? And we get to leverage their time. That way we get ours back. That's how this whole relationship works, okay? And it really takes a deal. I want you guys to go to the chat box. Tell me, not the chat box, the Q&A box. Tell me answer yes if you have active real estate in your portfolio, single family properties, small multifamily properties. Okay, put in the chat box, or sorry, the Q&A box, yes, if you do. Because if you do have active real estate, you understand it takes a village, right, to run these type of deals. You got to put together the broker, the lender, if you're doing rehab, you got to find the construction manager, you got to get a property manager, you got to secure insurance. Maybe you got to put together a legal structure. Oh, then at the end of the year, we're all in that tax and bookkeeping portion. Then you decide you want to sell the properties. Now you got to consider, do I do the 1031 exchange or not? Okay. Now, there are some certain things when we get at the higher, larger investment level, the operator brings all these things like you would to your individual or small rental portfolio. The operator brings these things too. Okay, so you can kind of relinquish this type of relationship. All right, let's say we got a lot of people that have like active deals in their portfolio, right? So if you have single family homes or small multifamily property, it's anything but passive. Even if you have property management, it's anything but passive. The only box you're checking is that it's passive income that you're earning, not passive with your time. All right. Now, what keeps, like I said, I promised you we're going to talk about some myths before we got into goals and then how to vet operators. What is the number one myth that keeps people from either starting off directly with passive investments or unwinding their single family small rental portfolio and moving that over to passive investments? And it's one thing. They tell themselves, I do not have control. I have no control over this investment. Why do I invest in it? Well, if you're invested in the stock market, you have no control there either. You have the illusion of control with liquidity. All right. But you don't get to pick the fund manager. You don't even get to pick the stocks in the fund or the ETF that you're investing in. You just have the illusion of control, which is, am I in the deal or out of the deal? All right. Now, if you are an active, real estate investor, and I call it active, if you got single family rentals, and guys, I'm not beating you up if you do, I still have single family rentals in my portfolio. I just got my beautiful performers, okay, in my portfolio still. You're still, trading time for dollars. All right, I'm going to let that one land for a little bit. You're still trading time for dollars, okay? You might be leveraged time, but you're still trading time for dollars. So how can we get you comfortable? How can we get you to the point where you're just like, ooh, I see the value here, right? I get to create massive leverage with a passive investment. But if I have this hiccup of control, how can I let go of that? And it's not about letting go of control. We need to put you in control. All right, so I'm going to put you in control here today. Okay, how do we do that? Well, first we have to understand, what does control really mean? All right, if you were on yesterday's masterclass, I was talking with Mark Fetzer with KQS Lawyers. He did a wonderful job of helping us understand the difference between risk mitigated investing and risk-free investing. And I will wrap up that conversation is there is no such thing as risk-free investing. You're always taking a risk, all right? So the reason why I mentioned that is because that kind of plays into our definition of control, right? Control means determine the behavior or supervise the running of, okay? It does not mean the mitigation of all risk, okay? So if we can't get rid of all risk, how can we make it as risk mitigate as much as possible? Well, we need to understand your goals, risk, and your timeline. Okay, we're going to start there today. Then you need to understand you get to control who you invest with, where you invest, and what you invest in. Okay. So what kind of control do you think you have in all your other assets? Think of your stocks, bonds, mutual funds, and cash in the bank. If these are the big areas that you get to control, do you have that same control in those stocks, bonds, and mutual funds and cash in the bank? Go to your Q&A box and I want you to tell me, do you have that control? If this is our definition of control, do you have that control? I'm getting a lot of like dead air. Okay, we got a couple yeses coming in. Okay, all right. Well, again, like if you're in the stocks, bond, and mutual fund space, do you get to control what what tickers are going in that particular stock, bond, or mutual fund? No. Do you get to control the weighting? No. Okay. Do you get to control the fund manager? that's running that? No. Okay. So like I said, let's not confuse liquidity with control here. All right. So our responsibility as a limited partner is that we have to get really good at understanding our goals, risks, and timeline, who we invest with, where we invest, and what deal we go into, which means we have to get really stinking good at due diligence. Okay. Right. Our other rules here as a passive investor, once we understand how to do the due diligence, we got to fund our investment, and then we just have to respond to any request of the general partnership. You elect this rule, okay, to get a return for your share of profits and to get your time back. Now, what happens with all the other responsibilities? Those go to the general partner. Okay, they're going to find the deal, they're going to purchase the deal, they're going to do all the maintenance on the deal, they're going to take care of any lending decisions and sale decisions. They elect for this heavy active role for a return on the cash flow and equity. Right? All right. So let's launch into those questions we need to ask ourselves to understand our goals. This is really where the workshop comes into play here. If you're going to invest in a passive real estate deal, you have to understand, you need to actually believe in real estate as an investment vehicle. So go to the Q&A box. I want you, again, this is all about us workshopping this here together. Do you, yes or no, believe in real estate as an investment vehicle? Can it help you achieve your investment goals? And we'll talk about those here in a second. We got a couple yeses coming in. All right. No harm if you answer no, because if you answer no, then that is revealing in and of itself. It's going to be really hard for you to scale a portfolio in this. Okay, we got yeses, yes, 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 yes. Okay, awesome. Okay, that's question number one. Do you believe in this, that it can actually help you reach your goals? Your answer can change over time. So for those of you that are like, oh, maybe or no, that means you just need to do more reading to understand how real estate has created more millionaires and billionaires than any other investment class. Okay. All right. Question number two here is I want you to workshop this, put it in the Q&A box. What do you need from your portfolio? Think in terms of today, but also 10 years from now. Okay. This is a big sticking point. I hear so many investors that are like, I need cash flow today, and that's all I need. Okay. That's what I want today. I need the cash flow today. And so they swing for the fence on these like high risk debt deals that yield 12%. And two things happen. One, three things. They get no tax benefit. They have no equity growth. And oh, by the way, something happens with that debt deal and like the cash flow evaporates. Okay. Another thing that I hear happen is people say, I have a great paying job right now and I don't need the cash flow. I only want the equity growth. Okay. So they're thinking only for that 10 years out, and they're not thinking, thinking for what they could need today, as far as like if they wanted to flip the switch and like work less or take a vacation, much needed vacation. So go to the Q&A box. I want you to take these. Do you need capital preservation, cash flow, equity, pass-through tax benefits, inflation hedging, diversification? Put in the Q&A box. What do you need from your portfolio? What are your top 3 things that you need from your portfolio? All right, guys, think about this. This is huge. The reason why we want to actually get crystal clear on what you need from your portfolio, and guys, you're only sharing it with me. Nobody else is seeing this, okay? The reason why you have to get crystal clear on this, and I challenge you on this, is because if you aren't crystal clear on what you need from your portfolio, you could end up in an investment that doesn't meet your actual goals. And 2, 3, 4, 5 years from now, you're kind of scratching your head going, that was for the birds. That didn't give me what I needed at all. So I'll tell you, oh, okay, awesome. We got a couple of people sharing. We got cash flow, we got leverage, we got tax benefits, cash flow, leverage. Okay, interesting. Awesome. Guys, hold on. I'm jumping ahead here. I'll share with you what I need for my portfolio. I need capital preservation. Rule number one, I do not want to get knocked out of the game. I need to be in assets that are going to preserve capital. So I need there to be some hard backing there. Rule number two for me, or what I need for my portfolio, I need cash flow. Now, here's the thing. Just because I need these things doesn't mean you necessarily need these things. But I want cash flow because I want to be able to, one, it tells me there's an element of stability with that investment today, even if it's just a little bit, like 3, 4, 5%. It's stable, it's profitable in today's environment, but I can take that cash flow because I don't necessarily need it right now, and I can accumulate it towards my next deal. I also want equity growth. I am not done growing my portfolio. And I want tax benefits. I want to create that velocity in my portfolio and keeping all of these things tax-free. Now, I don't let the tax benefits wag the dog, so to speak. Okay, that's not my main point of investing, but those are how I order my top 3 things. But for me, number one, preservation of capital. I do not want to get knocked out of the game. If I can preserve my capital, even if the investment goes sideways or south, I'm still in the game. I still got money to reinvest, right? Okay. And guys, I have lost money on a deal. Okay. It wasn't a real estate deal. It was a business play. I lost money and that hurt. I've also had real estate deals that broke even. Okay. Didn't make any cash flow, didn't make any equity growth. I kind of like quasi broke even, but guess what? I was still in the game. Okay. So for me, I have had to learn the hard way from the school of hard knocks that capital preservation for me is number one. Oh, we got preservation of capital, cash flow, and equity growth. Capital. A great question. Who would choose an investment in something that would lose their capital? I don't think anybody would choose to lose their capital, but a lot of people think about, they take unnecessary risk. Okay, that puts their capital at risk. Some people are quite fine. And there may be a phase in your investing. Like I've gotten to the phase of my investing that I'm like, okay, putting in like $25,000 or $50,000 on a deal and just seeing like the potential is there for me to like quadruple my investment. Like there's like an 85, 90% chance, but I might have like a little bit, there's a small sliver that I could lose it all, right? That's called betting, by the way. That is not how you should start off your portfolio. Anyways, guys, capital, perfect. Okay. But yeah, I don't choose. I wouldn't suggest anybody to choose to lose their capital. Definitely not that. Okay. So the third question here, again, I want you to workshop this, is what is your investment timeline? And you can answer this 2 ways. One, when do I need to hit my goals by? Is it 10, 15, 20 years? Okay. And then what is the longest term of investment that I'm willing to place right now? Okay, is it 3, 5, 7? Okay, I want you to go to the chat box and drop in those 2 numbers. Think about this. Okay. Okay, this impacts what type of risk that you might need to take in order to hit your goals, right? If you're somebody who's in their 20s, you have a longer potential road to invest. If you don't need to hit your investing goals for 20, 30, 40 years, right? You can take a slower growth route. But if you're somebody in like your 50s or 60s that you're just like, I want to retire in 3 years, okay, we need to create what we call alignment between your timeline horizon and what type of risk you're willing to take in your portfolio to get there. Okay, let's see. 2 years for near term goals, 5 years for long-term goals. Okay, so it's going to be challenging to find deals that are going to cycle out in 2 years, especially in the syndicated space. Okay, there are deals out there that that pencil to cycle out in 24 months. They're called development deals. Okay, that's a huge amount of risk, but there could be a huge amount of return to that too. All right, but if they generally have no cash flow. Okay, they just have equity and they no cash flow, no tax benefits. Okay, all right. So this is where you have to create this alignment, really think through this timeline, and you might need to sit sit with that. Okay. All right. But think about your timeline. What is your timeline horizon for your overall need for your portfolio? When do you need it to, like, flip the switch and you're living off of it? And what is the longest term of investment you're willing to take? For me, I look for deals that are 5-ish years, 5 to 7 years. And if there's a clear plan or an option, that they turn in 3, fantastic. I love that. Okay. But what that rules out for me is I don't do development deals. Okay. That's just not in my risk profile. All right. So again, these are just to help you figure out what is most suitable for you. Okay. Now, this is going to be a little bit more tangible, but I want to encourage you so much to think about this first question. What are you most nervous about when you invest passively? I want you to go to the chat box. Again, only I can see this. All right. There's no names attached to this. I'll be able to, like, I'll share some people's comments. What are you most nervous about in today's environment? And this is a very important question to ask yourself here, especially if you are hesitant about scaling your portfolio, or if you're hesitant about even starting your portfolio. Okay. Oh, okay. Somebody put in fraud. They're most nervous about fraud. Okay. What else? What else we got? The reason why I want you to really heavily consider this question, okay, because whatever you're most nervous about, okay, as we get into vetting our operators, this now becomes a question, a key point of due diligence you're going to ask a lot of questions around. Okay, this is how we're going to help you bust through the hesitation. Getting a good return, finding a good deal. Okay, great. All right. So one of your questions when we get to the due diligence for an operator is going to be like, what is your past performance and pro forma forward-looking performance? Finding a good deal, we're going to have to get a little bit more nuanced on that, because everybody's looking for a good deal. I don't know of anybody that's looking for a bad deal. But what is the deal? I would rephrase that. Does this deal align with my goals, my risk, and my timeline? Okay, that's how you're going to know it's a good deal for you. Okay. What most people are trying to do, okay, even with our fraud comment, they're trying to mitigate loss of capital. Okay. They're trying to mitigate capital calls. Okay. First of all, they don't want to lose their money. They don't want to actually have to add more money to a deal. Okay. They're trying to figure out, am I going to get the cash flow? Am I going to get my distributions? And then the business plan risk. Okay. That is super important for us to understand as we start investing in operators. But I'm keeping this contained to your goals, risk, and timeline section, because I want you to think through all these questions and really get clear on what is important to you, right? So I see a lot of investors, and I talk to a lot of investors on the phone, and they've got their due diligence list. Maybe they got it from a group that they're a member of, or they borrowed it from a friend, and they're asking all of these amazing, amazing questions. Okay. But the questions don't align with actually what they need from their portfolio. Or 2, they're not actually asking all the questions that would help them to suss out these risks that they're trying to mitigate. All right. So case in point, if somebody is trying to mitigate fraud, potential fraudster, okay, I would love to know the last 3-4 deals that you've opened up. Give me the LLC name. I want to go look them up on the Edgar.gov database. That would be a question I answer. I would also go online before I even talk to the operator. I would Google the operator, every single one of the managing partners' names in legal. Okay, or lawsuit. I would also Google the company's name plus legal and lawsuit. And I would, anything that popped up there, I would read through it. Okay. Those are some things that you specifically would want to add to your due diligence process. Again, we're creating alignment here. Okay. We want to make sure that whatever tool that I walk you through here between today and our future boot camps, that you are aligning to your goals, risk, and timeline. All right. Let's see. We've got a couple questions coming in. I'm going to take a brief pause before we transition into our underwriting the operator section. Yeah, could a poor business plan or business plan risk cause loss of capital? Absolutely. They could also trigger a capital call, which may not be like a bad thing. Okay, sometimes capital calls are not always bad. Okay, it means there was probably an unforeseen event that happened, but capital calls can also be an indication of a poorly run business plan. Okay, like why would you throw good money after bad, right? So we're going to get into sussing out the business plan risk when we learn how to vet the deal. Okay, so we're not going to answer all those today. Oh, awesome. Yeah, guys, there is going to be a recording of this. It will be posted on our YouTube page. So yeah, feel free to come back and watch the recording. All right, now we're going to get into vetting the operator. Okay, we've got to understand it. We know and love real estate. We believe in it as an investment strategy. We now understand what we need from our portfolio. Okay, those 7 metrics, those 7 wealth pillars, so to speak. We understand what our timeline horizon is, both short-term and long-term. We now understand what would keep us up at night. That's another way to kind of get at the risk question. What would keep you like up at night? Okay, those are the questions that, you know, if you've got a lot of hesitations, okay, that shouldn't keep you from investing. Those questions, those hesitations need to go into your vetting process. All right, so let's talk about how do we vet the operator. All right, so I have a 4-stage process for this. The pre-vetting, okay, the pre-call vetting stage. Okay, these are the things that I'm going to do before we even I even hop on the phone with an operator. Then I got my call vetting stage. What are the questions I'm talking about with the operator while I'm talking to them? Then I got my post-call vetting stage. All right, I'm reviewing all this information, I'm digging in deeper, I'm asking follow-up questions. If I need to schedule another call, I am doing that. Okay, and then I got my decision stage. And most investors, they go through stage 1 and 2, and then they like get overwhelmed and they're like, I have no way of keeping track of all this information and comparing operator to operator, and it's just also overwhelming, and I'm getting all these emails, so I'm going to do nothing. Okay, I'm going to show you how to keep the most important things through this process. So stay with me. If you need to watch the recording, go back and rewatch it. Okay, so stage 1, finding the operators. Okay, one of the easiest ways to find operators is to ask other investors, who are the best operators that you work with? Okay, who are the people that you know, love, and trust? Right? Okay, that is the best way to get not vetted operators, but get a short list of operators. You should never take somebody else's due diligence or somebody else's recommendation and then just go write a check. Okay, you still need to work the stages. Okay, you can also go to high-level conferences. A lot of operators there that are well capitalized will be attending these high-level conferences. You can join investment groups. There's several different investment groups out there. Like I can count in my head like probably 25 or more investment groups out there. Like Left Field Investors, GoBundance, Boulder Investment Group. Okay, but even these investment groups, you need to watch out. Sometimes operators get to advertise in the group. They get to pay to play. Okay, so you need to understand the goals of the group. In some groups, they're vetting the operator, but they're not vetting the deal. And then some investment groups, they're doing the whole shebang. Those groups generally cost like $15,000, $20,000, $30,000. They're vetting the operator, the markets, and the deals for you. But they generally cost $25,000 to $30,000 a year to join. My least favorite way, but still a very viable way to find operators, is to do a Google search. All right. So I'm going to get my list of operators. All right. Now I'm going to do some work before I actually, and I'm going to go ahead. If I want to, I could schedule the call because I could do all this work. But in the meantime, in those few hours or days that I'm waiting for the call to happen. But I highly suggest taking a moment, review that operator's website, make sure that on a high level, you guys are aligned with your goals. What do I mean by that? If they say that we do development deals and you need cash flow, you're not aligned. Okay, doesn't matter how highly recommended they came, just keep them on a list, because maybe your goals change for your portfolio in like 3 or 4 years, and now they're an operator you want to work with. Okay, but you're looking for those operators that are well aligned. Okay, and the next step, once you find alignment, or some indication of alignment, you're going to set up a call. Okay, set it up with the operator. All right, and then that should trigger emails to start coming to you. Okay, those emails are going to walk you through at a high level, what they do as far as investment strategy, who are their founders, what are their asset classes they invest in. Take a quick peek at those emails before you hop on the call. Again, making sure that you're aligned. Always do your due diligence. I'm going to drive this home. Okay. Now, when you jump on a call, okay, I want you you're going to ask these questions, or some form slate of these questions, and you're going to ask those questions that would keep you up at night. All right. We're going to get very good at interviewing, because remember, you are the CEO of your passive investing portfolio. You are looking for the COO to run that investment for you. Right? So if you're hiring an employee, so to speak, okay, remember, these are partnerships, but I'm just helping you if you run a business, translatable skills here. Do you like them? Do they seem genuine, authentic, transparent, honest? What is their background? Okay, how many syndications have they done? How many deals have they taken full cycle? Okay, what is the background and track record? What is their investment strategy? Okay, double checking for alignment. Okay, are they looking for cash flow, forced equity, buy and hold? Are they in this for equity growth? Are they in this for some sort of balanced blend of multiple wealth pillars? Okay, making sure you're aligned. I want you to ask them, what are the major risks of the investment strategies that they offer? Okay, particularly lending. I want them, have them tell you what their risk factors are. They should be able to tell you that. Who's on their team? Okay, what is everybody's role? Who's managing the asset? Okay, this kind of susses out your direct operators and sponsors versus your more co-GP capital raisers. There's pros and cons to, or advantages and disadvantages, to investing with one group or another. I personally like investing with the direct operator. Okay, I know I'm working directly, but sometimes a co-GP can get me in a deal that I wouldn't necessarily have access myself. So sometimes working with a co-GP is warranted. Okay, but you want to know, are you talking to a fund of fund? Are you talking to a co-GP, or are you talking to the actual operator sponsor? Okay, what is their communication plan? Do they communicate to you monthly, quarterly? Do they give you financials? When did they give you your K1? Have they ever had a deal go sideways? What you're looking for here are suspensions of distribution, capital calls, they ever lost investor money. Here's the thing. I can say no, that I, as an operator, I have never lost investor money if I have a deal that is completely upside down and I haven't sold it yet. I still get to say no. So you want to kind of tease out this information. Okay. What does their waterfall look like? What is their typical structure? How do they work with do they offer a preferred return? Do they have like an equity split? Is there any IRR hurdles in there? Okay, internal rate of return hurdles. How is that all sussed out? Do they do a GP catch up? We have our 8 red flags. Dan Hannaford has his article, The 8 Red Flags of Investing. We are very, very much a non-GP. We don't want to see GP catch-ups in our deals. Okay, so we want to make sure that we're looking for deals where the limited partner is truly put first. Okay, and then are any red flags present? And we'll touch on those right now. Red flags is there only one investment partner. Okay, maybe they're not full-time in their business. That's a red flag. Maybe they have no track record. They're not an active participant in the deal. They don't have a full team. okay, that has a full operational team with a full track record. They're not putting any skin in the game. They don't have a co-investment in their deal. Maybe they have a pro forma, or excuse me, a refinance underwritten or pro forma, okay? Maybe they're not using debt appropriately, okay? Maybe the debt profile, it doesn't match the actual business plan for the deal, all right? These are red flags. These are things that, if you find anyone in these things, that these should cause you pause and you should dig a lot deeper before investing, okay? It may not necessarily eliminate that investment for you, but these are big points where deals can really go south. There's only one partner, and that partner disappears like with all the money. Like there's no accountability. If they just don't have the track record or experience to run a deal, like they're new, that can be an issue too, right? So these are red flags for you to watch out for. All right, so we've gone through stage number 1. We created our list. Stage number 2, we actually got on the call. We asked all these questions. We asked our additional questions that would keep us up at night. All right. Stage 3, okay, we're going to wrap up our vetting process by actually taking all this information that we gathered, okay, and reviewing it after the call and asking follow-up questions, asking other investors their feedback and thoughts of working with that investor. And if there's anything that you find in here that you're like, oops, I didn't ask that question, or I don't really understand what you mean by this, or I just didn't, it's murky, I don't really understand, that should trigger a follow-up call, because you want to get 100% clarity before becoming partners with somebody for 3, 5, 7 years. Right? You guys are going to be in partnership together. You know, love, and trust each other. Okay. All right. Now, decision stage. Okay. This is the part where I think most people actually, they don't do the step number 3 very well. They just have the call and they kind of go about their day and they kind of forget to kind of pull all this information together, and they forget about things, and they're, 30 days later, they're looking to place a capital investment, and they scratch their head. They're like, who did I talk to? Right? Keep very organized. Keep a spreadsheet. Okay. Ask the same questions, operator to operator, so you can compare notes. All right. Decision stage, though, I also want you to decide, once you go through your call and reviewing all the information, are you going to delete, defer, or engage? All right. If you are like, I'm investing in the next deal they got open, or an open deal, a deal they have open currently, think about talking to investor referrals. Okay. Some people that have invested in their deals currently. Okay. Don't be afraid to engage. Okay. If they just are like, wow, I don't know, love, and trust this person, I wouldn't touch them with a 10-foot pole, unsubscribe. Get off their list. Okay, don't allow them to take up space in your email box. If they are somebody you're just like, I really love this investor or this operator, this is somebody I could really get behind, but right now is just not the right time. Either I don't have the capital, or they don't have a deal open, or something else is, it's just the stars aren't lining up. Create a folder in your email and send all their investment emails to there. Okay, and review that folder once a week, or once a week, once every 2 weeks. Okay, because you don't want to miss the deal if they put it out, but keep tabs on them, but make it an aggregated system. So for me, I have all my investor communication. I have if I'm actively investing with an operator, I have a folder that it goes to, right, in my Gmail. And then if I'm operators that I'm looking at, I have another folder, and I periodically review that folder. All right, this will help you keep you organized, right? But most importantly, you're going to have that spreadsheet, right? So vetting the operator, make sure you do the pre-call vetting stage, the call vetting stage, hop on that call. Okay, post-call cleanup. Okay, this shouldn't take you very long, and then make a decision. All right. Guys, I'm going to open the floor for questions. We've got about 9 minutes for questions. This is your call to action, that if you haven't done so already, make sure to join me at passiveinvestingwithwhitney.com. Okay, you got all sorts of free goodies there. If you are interested, if you're ready to go for 2024 and you're ready to engage with an operator or invest in a deal, multifamily self-storage, real estate debt, express car washes, preferred equity in multifamily real estate, the time is now. Get your operators in order because deals are going to start coming.